Welcome to LexiCast, a podcast designed to help you grow in your legal practice, with weekly updates on current topics, trends, and practical insights. Perfect for listening on the go. Let's dive in.
Welcome to today's episode. Today we will be looking at, a comprehensive deep dive into directors' duties, liabilities, risk management, and compliance under Australian law.
Yeah, it's a massive area to cover.
It really is. And we are framing this deep dive specifically for you, the listener.
Exactly.
Because if you're a legal practitioner looking to solidify your understanding of corporate governance, whether you're advising current directors or maybe someone who's just about to step into the role for the very first time, this is exactly what you need.
Absolutely. The sources we're unpacking today, they provide this really dense but highly practical legal framework.
Right. They're packed with the recent case law, the statutory provisions straight from the Corporations Act 2001, and some really direct insights from ASIC Chair Joe Longo.
Yeah, and his insights are fascinating because they show how the law tries to regulate human behavior, right?
Yeah.
Like that tension between taking necessary commercial risks and, just exercising reckless apathy.
Definitely. But before we can even explore the rules of the game, we first have to clearly define who is actually playing it.
Which is harder than it sounds.
It is.
Oh.
Because as the sources reveal, the title of director isn't always, neatly written on a business card.
No, it's not. The law doesn't let someone just hide behind a lack of official paperwork.
Right. So let's talk about Section 9 of the Corporations Act.
Yeah.
Because the definitions there expand into what they call de facto and shadow directors.
Yeah, which basically means if you're pulling the strings, you're on the hook.
It's like a corporate duck test, right? If a person walks like a director and makes top-level decisions like a director, the law considers them a director.
That's a great way to put it.
Can you break down the DCTV Austin case for us? Because I think that illustrates this perfectly.
Oh, definitely. So in the Austin case, Mr. Austin was appointed as a director of a company that ran a restaurant.
Okay.
But when the business started hitting some turbulence, financial trouble, he wanted out. So he officially resigned.
He actually signed the paperwork, right?
He did. His accountant drew up the forms, he signed them, but, and this is the kicker, those forms were never actually lodged with ASIC.
Oh, wow. So administrative failure.
Exactly. But that missing paperwork wasn't even the decisive factor for the court.
Really?
Yeah. Justice Madgwick and the court, they looked entirely at the substance of Mr. Austin's behavior. After he supposedly resigned, he didn't actually step away from the controls.
So he was still acting like a director.
Exactly. He was actively negotiating with the Deputy Commissioner of Taxation. He was managing these aggressive creditors, handling the company banking.
All top-level management stuff.
Right. He was exercising actual top-level management functions. So the court ruled that allowing a missing lodgement form to shield someone who was practically directing the company, that would entirely defeat the protective purpose of the Corporations Act.
So he was deemed a de facto director.
He was. And the legal takeaway there is crucial. The court looks at the substance of the role, not the paperwork. You can't just resign in name but stay in control.
Okay, let's unpack this. Because once we know someone is legally a director, who exactly are they serving?
Well, the immediate assumption most people make is that a director serves the current shareholders.
Right, the people holding the stock today.
But that's a dangerous oversimplification. Fiduciary duties under the general law dictate that duties are owed to the company as a whole.
Meaning the entity itself.
Yes, and crucially, this means balancing the current members' interests with the interests of future members. You can't just, gut the company's long-term viability to pay out a massive dividend today.
But doesn't that calculation fundamentally shift at a certain point? Like when a company approaches insolvency?
Well, absolutely. That is a critical pivot point. When a company is approaching insolvency, the primary duty shifts heavily toward the interests of the creditors.
Because the risk profile has changed, right?
Exactly. When a company is solvent, it's the shareholders' capital that's at risk. But when it's sinking, the creditor's money is effectively what's funding the operations. So directors suddenly have to factor in creditor interests as paramount.
Wow. Okay, so now that we've established who holds the power and who they serve, we really need to examine the specific obligations tied to that power.
And it's a dual-track system, which makes it complex.
Right, because we have the general law, so common law care, and equitable fiduciary duties like good faith and avoiding conflicts operating right alongside Part 2D.1 of the Corporations Act.
Yeah, the Corporations Act basically took those old equitable principles of trust, codified them, and added some really severe statutory penalties.
So let's do a deep dive into Section 180, which is the duty of care and diligence.
This is the big one.
It is. The standard requires a director to exercise the degree of care that a reasonable person would in that specific corporation's circumstances. But I want to push back on something here.
Sure.
Wait, so if a director genuinely, honestly believes they're doing the right thing for the company, they can still be in breach?
Yes, absolutely. Good faith alone isn't enough to satisfy Section 180.
That feels harsh.
It does, but it's about objective diligence. The best example is ASIC v. Casamatis, the Storm Financial case.
Oh, right.
Yeah, so the directors there, they owned all the shares in the company, and they honestly believed their strategy was brilliant.
And what was the strategy?
Basically, they were heavily gearing vulnerable retail clients into index funds.
Yikes.
Yeah. But the federal court ruled they breached Section 180 because that strategy exposed the company to a foreseeable risk of catastrophic regulatory action.
Even though they meant well.
Exactly. Even without immediate financial loss, just exposing the company to that level of foreseeable harm, it's a breach.
And we just saw this recently, didn't we? In the 2025 ASIC v. Hawkins case with Star Entertainment.
We did. And that case really lowered the threshold for what constitutes harm.
How so?
Well, the officers in that case didn't cause a direct financial loss. The breach happened because they passively received reports about severe money laundering risks in their VIP rooms.
And they didn't do anything.
Right. They failed to actively interrogate management about how those risks were being mitigated. Exposing a company to foreseeable regulatory or reputational risk, even without financial loss, is a breach.
So you can't just be passive.
Not at all. That's why ASIC's chair Joe Longo says that curiosity is an absolute necessity for modern directors.
Curiosity as a legal duty.
Exactly. If you aren't asking questions to understand foreseeable risks, like cyber attacks are a prime example he calls out, you are failing your duty.
Wow. Let's rapid fire some of the other key statutory duties then.
Okay.
Section 181, that's good faith and proper purpose. And the sources cite Duncan v. ICIC here regarding true disclosure of conflicts.
Yeah, Duncan is fascinating. The director stepped out of the room when a vote came up because he had a conflict of interest.
Which sounds like the right thing to do.
It does. But he breached the duty because he didn't fully disclose the true extent of his conflict before he left. You can't manage a conflict with silence.
That's a great point. Then there's Section 182, improper use of position. The R.V. Burns case confirms that you don't even need malicious intent to cause detriment to the company, right?
You're right. Objective misuse of the role is enough. And then you have Section 183, which is improper use of information.
But the really crucial context here for any advisor is Section 191, isn't it?
Oh, absolutely. Section 191 is the strict statutory requirement to disclose material personal interest to the board. If your spouse owns the firm the board is about to hire, you have to disclose that.
Because it triggers everything else.
Exactly. And I should also briefly mention Section 140. A company's constitution actually acts as a binding contract with the director, so that creates overlapping contractual liabilities too.
Okay, so failing to act with care is one thing. But the sources show that the legal framework has these specific tripwires that elevate a corporate misstep into, like, personal ruin or even criminal territory.
Yeah, the consequences escalate very quickly.
Let's talk about Section 588G, the duty to prevent insolvent trading, and Sections 285 to 315, maintaining financial records.
Those two are deeply connected. Directors can't just blame the accountant if things go wrong.
Right.
They legally must have access to and maintain those financial records. You can't say, oh, my bookkeeper had the files. The liability is on the director.
Here's where it gets really interesting, though. When does a bad business decision actually become a crime?
That's Section 184. If you breach the duties of good faith, use of position, or use of information, it becomes a criminal offense if the director is reckless or intentionally dishonest.
And the penalties are severe, right?
Up to 15 years imprisonment.
15 years. But how is recklessness defined? Because that sounds a bit subjective.
Under the criminal code, recklessness means taking an unjustifiable, substantial risk. It's not just a bad guess. It's ignoring glaring red flags when you know the risk exists.
And this criminal element extends to paperwork, too, doesn't it? Like Sections 1308 and 1309 regarding false or misleading statements to ASIC.
Yes. There was a recent enforcement example where a director just ticked a standard box on a form saying the company had no debts.
That they did.
They owed money from a tribunal order. That one false checkmark led to criminal charges.
Wow. Okay, so understanding the boundaries of the law only really matters if we understand the severe penalties waiting for those who cross them. Let's look at the teeth of this regime.
The civil penalty regime under Section 1317G is massive.
It is. I mean, penalties can reach 5,000 penalty units, which is currently about $1.65 million, or 3 times the benefit derived from the breach.
And that's just the financial hit. There are disqualification mechanisms, too, under Sections 206B and C.
Like being banned from managing a company.
Exactly. Certain breaches lead to an automatic 5-year ban, and if you try to manage a corporation while bankrupt or disqualified, that is a standalone offense.
So the corporate veil isn't a magical force field. When does it drop entirely?
It drops with the ATO. The Australian Taxation Office's director penalty regime is brutal.
How does it work?
If a company fails to meet its PAYG withholding, GST, or superannuation guarantee charge obligations, the director becomes personal liable.
Personally, like out of their own bank account?
Yes. The tax debt effectively transfers to the individual. And here is a critical tip for you, the listener, to advise your clients. Check for unpaid liabilities before accepting a board seat, because liability attaches upon appointment. If you walk into a company with a massive unpaid super bill, you become personally liable for it very quickly.
That is terrifying.
It really is.
Okay, so having thoroughly scared any prospective director listening, we now must explore the armor the law provides. I mean, we need people to take responsible risks. Right?
Exactly. The law has to protect honest corporate leaders.
So let's look at the business judgment rule under Section 180, subsection 2. Is this basically a get-out-of-jail-free card for bad investments?
No, not at all. It has very strict limitations. First, it only applies to Section 180, the duty of care and diligence.
So it won't save you if you breached good faith.
Exactly. It will not save a director from a conflict of interest breach. To use it, you have to act in good faith, have no material personal interest, actively gather information, and rationally believe the choice benefits the company.
So you have to do your homework. What about Section 189, relying on expert advice, or Section 1317S, exoneration?
Relying on experts is fine, but a director must still apply an inquiring mind. You cannot blindly rubber stamp an advisor's recommendation.
You have to actually understand what they're telling you.
Right. And for exoneration under 1317S, the court can excuse a director, but honesty is key. If there's any hint of deceit, you won't get relief.
Which brings us to a really practical risk management tool. D&O insurance. Directors and officers insurance.
Yes, and the AICD, the Australian Institute of Company Directors, has a crucial advisory note on this.
What's their advice?
Don't rely on summaries from brokers. You need to ensure your specific name and role is listed in the policy.
Read the fine print.
Yes, and critically, you must demand a runoff cover of at least 7 years.
Because liability outlives the resignation letter.
Exactly. You can be sued years after you leave the board. If the company cancels the policy, you're exposed unless you have runoff cover.
Good to know. And just briefly, there's also the DION regime, right? The director identification number.
Yeah, that's mandatory now. It's designed to stop illegal phoenixing, where directors liquidate a debt-ridden company and just start a new one to avoid paying creditors.
Right. So as we wrap up, I want to pose a final provocative thought.
Okay.
It's regarding the evolving definition of foreseeability.
Yes, this is huge.
With the ASIC v. Hawkins case cementing that regulatory and reputational risk have to be actively managed even without financial loss. How will courts judge a director's failure to oversee emerging complex risks in the very near future?
Like what?
Like artificial intelligence governance or ESG compliance, environmental, social, and governance.
Oh, that's a fascinating question.
Right. If an AI system the company uses suddenly violates privacy laws at scale, is ignorance of complex tech now a breach of care?
It very well could be, because the risk of AI failure is highly foreseeable now. You can't just say, I'm not a tech person anymore.
So what does this all mean? It means curiosity isn't just a good trait for a director, it's a legal mandate.
Absolutely. You have to ask the hard questions.
Well, that gives us all a lot to mull over. Thanks for listening.
That's it for today's episode on LexiCast. If you're looking for more in-depth episodes that can also be claimed as CPD activities, check out our LexiCast CPD Plus page linked in this episode's notes. Follow us now to stay up to date, and we'll see you next time.